This session is sponsored and programmed by Nuveen.
I'm Caroline Woods, and today I'm speaking with Lauren Ferry, head of portfolio strategist at Nuveen, about enhancing income portfolios in today's volatile and uncertain markets. Let's get right into it, Lauren. When it comes to investing, income portfolios didn't always require higher risk investments. That has changed. So let's talk about the need to add risk in order to generate income and how that has impacted the way you do business.
It's very true. I mean, we're having to do things that we haven't historically had to do. 20 years ago, generating income was a one-trick pony. We could just invest in US treasuries. The situation today is so much more complex. What we're seeing with our clients is that they're adding more risk. They're adding more credit risk, more duration risk, more volatility risk. The problem is this means that we're adding more risk to portfolios of clients who typically don't want more risk. So the two biggest pieces of advice that I give to our clients at Nuveen are to, one, stay invested, that's so important, and then two, to stay diversified. And by that, I mean diversifying risks.
So let's talk about how to actually do this. How do you construct your portfolio to generate income when rates are essentially at zero? And we've already seen a huge run up in equities. Some would say valuations are stretched.
Precisely. So how do I stay diversified? Well, if I'm taking on more risk, how do I generate income but stay diversified? It's the question that comes up time and time again. So what we do is we work with clients to construct diversified income portfolios. And one way that we do this is by broadening where we're sourcing income from. However, there's a catch, right? There's always a catch. Adding more sources of income doesn't mean necessarily that we're adding diversified sources of income. So adding more equities, adding more credit, they have some overlapping underlying drivers of return, and that could present really undiversified portfolios. What we tell our clients, it's sort of our mantra, is not all yields are created equal. And what I mean by that, so I'll give you an example. So let's take two asset classes: emerging market debt and senior loans or leveraged loans. Their yields are roughly the same, just shy of 6%. But what drives total portfolio performance of these two asset classes is quite different. The emerging market debt actually has a lot of sensitivity to equity markets, believe it or not. And they also have like a special sauce, like I like to call it, called idiosyncratic risk, which is a key ingredient to improving portfolio diversification. So we always want to extract as much idiosyncratic risk out of asset classes as possible. And then on the other hand, with leveraged loans, they actually have more sensitivity to credit risk. So while their yields are the same, the underlying risks that are presented are quite different. So knowing what drives these asset classes, whether it be interest rates, credit, or equity markets, and then having a forward-looking view on those drivers, this is what helps us construct diversified portfolios.
How can a core fixed income allocation or strategy serve your clients well when market volatility ticks up? Because given the current landscape, be it the global pandemic and the resurgence in COVID cases, the upcoming US election that could be contested, and uneven economic recovery, volatility could be the name of the game for quite some time.
Yes, so it's the number one question it seems we're getting from clients. Should I just ditch the 40% in my 60-40 portfolio? The answer is no. There is a role for traditional fixed income to play in diversified, balanced portfolios, even where yields are today. I understand. I understand why people are concerned. When rates start to decrease, when rates start to increase, which eventually they will, what's going to happen to bond prices? They're going to fall. So I have this trick that we share with our clients. It's sort of like a back of the envelope way to measure what the impact on the capital or of your investments will be when rates rise. So if you take your portfolio yield and your portfolio duration, so you take your yield and you divide it by your duration, just those two numbers, and what the result gives you is if there's a rate increase, how much can that rate increase, how high can rates go before you experience a capital loss? Think of it as like your break-even point. So let's use some numbers because that always is helpful for me. Say your portfolio yield is 5% and your duration is 7 years. So you divide those two numbers, 5 by 7, and you get the 71 basis points. So rates can go up 71 basis points before you start to experience a headwind on your capital. The other route, aside, looking more closely at your fixed income allocation, is to just address it at the source, address that risk or volatility at the source. And it's likely emanating from the equity side of your portfolio.
What's the role of cash in a portfolio, Lauren? Savers certainly aren't being rewarded with high interest rates. They're almost being penalized for saving. So what's your take on that?
I'm so glad you asked this question. Honestly, you're definitely penalized to hold savings in cash. Cash is not a good investment. Think about real yield. So this is yields after taking into account inflation, and we're in the negative territory after you account for inflation. So it's like filling your canteen with water before going on a long hike. And then you've reached your destination and you've realized you've had a leak the whole time. That's the impact of inflation. And so when you're holding cash and you're not collecting any kind of yield or income, you're left in that type of situation. Back in June, it was spreading across headlines everywhere. I almost fell out of my chair at home, of course, since we were all home. I saw this headline repeated everywhere about $5 trillion of investable assets, i.e. cash, sitting on the sidelines. I just made my stomach turn. If we can't time markets and we really can't afford, especially with yields where they are, to have a cash drag. So let's invest it. Let's use the income generated to provide the liquidity that our clients need.
Lauren, what's your take on using some of the cash on the sidelines and investing in alternatives? How can that play into your strategy?
Yeah, Caroline, we often get questions on how to introduce alternatives into a portfolio. They can provide a robust income source, but there's sort of like a checklist that we work through. And it starts with a little bit of rule clarity on why you're investing in the asset classes you are. So let's take fixed income since we were just talking about it. Core bonds, they're historically there to provide the income and to provide that cushion during market volatility. But we know that there's a limit to that given where yields are today. So what can we do? We could just think about, is private credit a good substitute or complement to our core bonds, right? Yes, it's giving us the income that we're looking for. It's providing a source of diversification, but what's the trade-off? There's always a trade-off. It could be introducing more liquidity risk or illiquidity. So then we have to just kind of go down that list and say, all right, well, can I give up a little bit of liquidity? I don't think that most clients in our experience really need their whole portfolio to go to cash anytime soon. So I would say you can probably give up a little bit of liquidity for that extra yield premium. Then there's another take on it too. Say fixed income isn't giving you protection that you're looking for. Say you're concerned about inflation. Fixed income is going to be less useful in that case, but what asset classes can I generate potentially better income, provide diversification, but then also help on the inflation front? Well, real estate is a great example of an asset class that can do all three of those things. Cap rates, which give us a forward-looking view, they're at very attractive levels at the moment, and that indicates very strong relative value.
We'll leave it there. Lauren Ferry, Head of Portfolio Strategists at Nuveen. Thanks so much for joining us. Really appreciate your insights.
Yeah, thank you so much, Caroline.